Hello again, everyone. It's Vince Four from TradingWinds.com, and this is our update for September 18th, 2018. Let's take a quick look at today's markets. Well, we saw a strong bounce for the equity markets today. All four major index charts closing significantly higher. The Dow Jones Industrial Average was up 184 points, while the S&P 500 managed to gain 15.5 points, actually hit a new intraday high here today as well. The Nasdaq was up 60 points, and the Russell 2000 gaining almost 7.5. Now, going in the opposite direction was the bond market, and I'll get back to this in a moment. It is very, very important, I think, to keep an eye on the bond market going forward. But the drop today resulting in a significant spike in yields, in bond yields. The 10-year Treasury note is now sitting at 3.056. That is the highest level since it's been at since the month of May, that is. Crude oil gaining sharply as well, gaining almost 1.5% today. This on news that it looks unlikely that OPEC will boost production here, boost output. Gold futures dropping about $2.80. This on a bounce in the U.S. dollar. Not a big bounce, but a slight bounce today in the U.S. dollar. Now, let's get back to TLT here, the 20-year, the ETF for the 20-year Treasury. And you see the sharp drop. Now, what was interesting today about the bond market is that with all the talk, about the trade war, the potential escalation of a trade war between the U.S. and China, we find out that China's U.S. Treasury holdings are at a 6-month low. Now, they're still extremely significant. They're still over $1 trillion. They're $1.17 trillion. Okay? So they hold a massive amount of U.S. Treasuries, but they've obviously been selling some. Now, is this their way of retaliating against the tariffs that the U.S. has put on China? If it is, everyone should sit up and pay very, very close attention to this, because if they really want to, and they sell those treasuries, they can really cause a huge spike in yields, okay, on bonds, which would cause a lot of problems for the U.S. First of all, for the U.S. to carry debt at higher yields would be very, very difficult, and they already have a substantial amount of debt. They need to continue to sell bonds to bring in cash to run the country, and that'll be difficult. But for the equity markets, it would be a disaster. The reason being, once yields go up and people can put their money into something that they consider safe, like a bond, like a U.S. Treasury bond, at a substantial yield, that would cause them to move money out of the stock market and into the bond market. So this is something to pay close attention to. Nothing to panic over yet, but if you look at TLT here, getting very close to these lows at 116, and we've talked about this before. Look at the weekly. This is a very, very crucial level here, the 116 level. Let me draw this across here. So we're getting very close. We're at 117.31. If we bust through that 116 mark, we could be heading to as low as 101, which would cause a major, major spike in yields. So continue to monitor these yields. We will, and we'll certainly keep you up to date with what's happening. But that's about it for now. Enjoy the rest of your day, and we will see you on our next update.